This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Walmart's shocking move is rocking retail. We're going to show you what Walmart's doing and why, when you understand what's going on in the U.S. economy, while many other retailers will soon follow. And with that, let's over to the Wall Street Journal, where we picked today's story up with a headline: Evergrande negotiating 11th hour restructuring deal to avoid liquidation. And you can only imagine, if one of China's biggest property developers goes into liquidation, this is going to send all-out panic in China's real estate market. And as we've noted in prior shows, Beijing is trying to reignite the consumer demand for property there. And if you see a developer go into liquidation, it's going to cause outright panic. Sales are going to dry up. And as we have noted, due to the heavy connection between China's property markets and the banks, it's going to send even more of China's banks deep into insolvency. In a recent proposal, Evergrande has offered to give control of around 20% of its Guangdong-based parent company, China Evergrande Group, to its creditors, the People said. To comply with Chinese regulators' demand, Evergrande wouldn't issue new debt as part of the restructuring. So here you have the case where they want to give effectively worthless stock to their credit holders. And of course, as you can imagine, the credit holders said, no, we're not interested in that at all. As Evergrande's offshore creditors, however, have put forward a counter proposal that would give them more control of the company's offshore businesses, arguing that they would own all of the parent company if a Hong Kong court puts it into liquidation on Monday, putting a stress on this deal getting through. The parties are prepared to negotiate through the weekend, and bondholders are still hoping to reach a consensual deal with the company. So keep an eye out Sunday evening. Watch the news for this, because if they go into liquidation, you're going to see a big reaction in the market and likely the Chinese stocks of other property developers, and it's going to ripple into the banks as everyone starts to panic that they're not going to get their money back, so they need to get what they can out while they can. But is Beijing worried about this? Well, at least not as much as we might think. As China Xi seems delaying key economic plenum define the norms. Now, this would make a lot of sense if things in China's economy were doing well and there was not a big catalyst here. But what we can note is the Chinese economy is in dire shape. So this kind of extension here doesn't make much sense. As the next third plenum may not be about the economy at all, we're going to make a case it's going to be only about the economy. As the U.S. think tank said, look, this could be about other things, citing the 2018 meeting when party officials spoke about governance reform, adding the third plenum may be determined by other considerations. Look, if your property market is cratering and your developers are crashing, threatening to turn all of your banks that you're trying to bail out into a largely insolvent group that's going to ripple through the global economy, the last thing you're going to worry about is governments. You're going to focus on the economy because you needed to turn it around in a big way. But one of the problems China is facing right now is export demand for their products and services. It's just not there. As we can look at just what's coming to the U.S. from China alone, as we look at U.S. imports of goods by custom basis from China, this in blue against the consumer price index in red on a year-over-year rate of change, and we can see that imports from China are negative. That means demand for Chinese goods are down, and that will have an impact on their manufacturing sector and their labor market, suggesting that Chinese consumers and workers aren't going to be that optimistic about buying a home when they're not seeing the demand from overseas. Of course, what this means is you can see with a lag, the consumer price index indeed headed much lower, even though many Federal Reserve officials don't believe that we've got inflation contained. They're still panicking and still worried that it's going to come popping out of nowhere. We're making the case of what China does. Remember, they export deflation. They're clearly doing it, and their economy is getting far worse shape. But one other economy that we've noted in the past that's in trouble is that of Germany's. But now we have new evidence that shows they even have a bigger problem on their hands than their manufacturing sector, which is deep in a depression. As Cigna's lofty property valuations point to brutal pain to come, and I want to point out that this is also going to affect the U.S. banks. We also know that the U.S. commercial real estate market is massively overvalued. So when we look at what's going on in Germany, well, I want you to understand that this is just the same thing that we're going to be facing here in the near-term future. But one thing that shouldn't be brutal is the performance of your trading account. At least it should be going in the right direction, because many people say, Steve, I don't know. I'm trying to trade. I'm trying to make money trading, but it doesn't work. And let me show you. It's so easy using our reports. You can use them together or separately. But let's talk about machine positioning, because on the Sunday show, we're going to talk about how critical knowing where the machines are going. We give you a report on that. Here you can see our CTA Timer Pro. This mimics machine positioning. We're going to look at our gold trade that we put on back at market open on November 17. What we noticed was gold was coming out of a short position. We had been watching this for a re-entry buy. We noted that happened on November 17th. Now, some of you like to trade technical signals. Well, we do that too, but one of the things that people say is they're so confusing. Steve, you got these RSI things and the MACDs and the Stotches and all these other indicators. How do you know which ones to use? Well, we take a bunch of them and smooth them all out for you and run technical signals. We give you the momentum change, and we were waiting for this. This is the pair trade. This is where most successful traders using our reports do. They have both of them, and on November 17th, we had one signal on GLD that said momentum had now moved to the upside. You put that together, you would have bought here on this little red candlestick at market open, and right now you'd be at 4.4%. Talk about a way to pay for all of your research in 1 year on one trade. And here's the best thing about it. There are 3 coupon codes for free month for each of them. So that way you can trade them, make money using the reports, and you can see the value behind it. Get them before they go. If you get to the checkout and they're not there, well, it's because 3 people beat you to it. And an up-to-date valuation for Cigna would likely produce a fall of around 1/3. This is the same issue we've been making for the U.S. commercial real estate market. If they start properly valuating these buildings, they're going to see they're worth significantly less than what the market expects them to be, far less than the current value of the loan, putting more stress on the U.S. small and regional banks, which we know they're insolvent. Then that's a problem, because they can't take any more abuse. As difference between book values and what buyers are actually willing to pay are of little issue in a booming market, suggesting that banks will lend in a booming market, no problem. But with a queue of creditors desperate to get their money back, forced sales by Cigna are a possibility, and the reality check could put some loans at risk and have widespread implications as deals reset the broader market. So again, you're facing the potential that loans are not going to get paid, meaning the banks, of course, that have no money to begin with that lent against these, would have to put more money into reserves. That means they'd have to lend less, but they're already borrowing from the Federal Reserve in a big way, taking big money loans at high interest rates. You can see that if this happens in America, if we start revaluating our commercial real estate property, just as what's about to happen in Germany, what you're going to see is a major crisis. If you think that the global financial crisis was bad with mortgages, wait till you see what happens to commercial real estate. Cigna's implosion highlights the extent of which Germany is becoming the epicenter of Europe's commercial real estate crisis. While Benko's group is based in Austria, most of its portfolio is in Europe's largest economy, where the property market was seen as a safe haven until recently. When interests were at rock bottom levels, referring to rates, the country's growing economy and anemic construction meant rents and values were rising rapidly, luring investors like Benko to bid up prices. And hence, many of you say, I see them in the comments, say, Steve, there's no way rates are going to go down. Well, wait till you find out these buildings are worth 2/3 of what they were lent against before. You're going to watch central bankers have no choice but to drive rates back to zero to try to boost asset prices to keep the banks from failing. The problem is we've already been at zero not just once, but twice. If you think the third time is a good one, well, don't worry. It means they're going to have to figure out how to take rates negative, because third time at zero isn't going to have any impact at all. Meanwhile, Germany's property debt is now being sold in the secondary markets between 30 and 70 cents on the euro. You're talking about market pricing in that these loans are already insolvent and not going to get paid. Those are big revisions. We're not talking about rounding errors here. Again, you see the stress in the commercial real estate market. The longer the central bankers invert money curves, it causes bigger problems in the broader economy. It's only going to be a matter of time before we're seeing headlines in the U.S. about the commercial real estate crisis. We can now keep an eye on Germany, who may lead us on the way down. But Wall Street thinks that's not going to happen as they bet on a soft landing in the best month since 2008, suggesting that what could Walmart be up to that could be so bad? This time may be different? Well, perhaps. While Fed Chair Jerome Powell pushed back Friday on the prospects for interest rate cuts, the central bank's historic tightening campaign is seen as game over, man, across the markets. At the same time, the risk-on exuberance is working against Powell's goal of tightening financial conditions, a back-and-forth dynamic that has contributed to the demise of past rallies. And so what you see here is Wall Street and investors betting that interest rates are going to go down, and that's all it's going to need, that the Fed's going to cut a little bit, maybe once or twice. At some point, the Fed's going to have to bow to the pressure of the bond market, trim rates a little bit, and this is going to send the equity market screaming higher. The problem that equity investors don't understand is it's all about money. You've got to have new money created to support equity valuations at higher and higher levels. So when central banks constrict the creation of credit through the commercial banking system, well, history says it doesn't bode well for stocks at all. In fact, if we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, that in blue, where you see the blue line above that horizontal black line, says the banks are tightening on the way up at a faster rate, on the way down at a slower rate. And underneath that, we've got the Wilshire 5000 price index. What we can note is this banks tighten standards, well, stock prices tend to go down. And yet, here what you see, investors bucking the trend here, believing that the soft landing narrative is actually going to occur. They want to get in early on this new bull market. The problem is history suggests that this thing may actually go all the way up and make new all-time highs. It could do that. It could go a little bit higher. But the reality is, as we dig deeper into the economy, and even what Walmart is experiencing right now tells us that the eventual path of the equity market, when money dries up in the system, is going to be much, much lower. And some evidence the economy is not in great shape is U.S. boat sales to sink to decade low. Of course, this doesn't bode well for the stock market, and when consumers run out of money, certainly doesn't bode well for companies like Walmart. As Bloomberg cites new data from the National Marine Manufacturers Association, the leading trade association representing boat, marine engine, and accessory manufacturers, which states that 1.4 million new and used boats were sold in 2021, up 16% from 2019, followed by several years of low-digit growth. Now, what we're seeing is the high-rate environment has frozen the industry as new and used boat sales are expected to plunge to a decade low this year. Of course, we know when sales go down, well, you need a lot less of something, and that is salespeople and people to work in your business. They'll be hitting the unemployment line here in the months to come, as we know. But as we still look forward, there are danger signs and warning signs all over the U.S. economy. And as we look to the manufacturing sector, well, we see nothing that gives us any sort of optimism. Here we see the ISM manufacturing report on business. The PMI came in at 46.7. Now you have to remember, 50 is unchanged from the prior month. So it just says whatever growth you were occurring at 50, that means you see the same level of growth the following month. Above 50 is an expansion, meaning growth is occurring. Below 50 is a contraction, not something you want to see when Wall Street is buying into this soft landing narrative. What we should be seeing is a manufacturing sector at least somewhere around the 50 mark and heading higher, because remember, where manufacturing goes, services sector usually follows with a lag of somewhere around 2 to 3 months, despite experts saying that this time would be different. The services sector would lead manufacturing. Well, history says not at all. But look at the headline here. We see new orders and backlog contracting. Well, that's not what you want to see, because that means employment and production contract. And that's right. When you have fewer new orders and fewer backlogs, well, you need fewer workers. Supplier deliveries are getting faster, suggesting that any problems in the supply chain are easing. Raw material inventories are contracting. Customer inventories. And this is shocking, because we've seen them say, hey, our inventories are too low. And we're kind of wondering, what are they thinking? Well, now all of a sudden, they've flipped. And prices are decreasing as exports and imports are contracting. Look at this. Demand remains soft, the ISM says, and production execution is slightly down compared to October as panelist companies continue to manage outputs, material inputs, and more aggressively now labor costs. Of course, when you are managing labor costs and you've had to give everyone a raise because, of course, consumer prices have gone up, and what that means is you manage them by getting rid of employees, and that's exactly what we're starting to see in the manufacturing sector, something that we warned would have major implications on the U.S. economy. Here you can see new orders continue to contract, this from October, now contracting still in November, although not as quite a steep rate, but still contracting. We noted that in October employment contracted. They're continuing to contract here in November as we look towards next Friday's payroll report. Well, any idea that it's going to be lights out? Well, don't expect it. The lights could be turned out as we see a disappointing payroll report coming next Friday. Look at this. Customer inventories now shifting from too low to too high. Backlog of orders contracting at a massive rate. Last month at 42.2, this month at 39.3. It says contracting, and again at a faster rate, meaning the backlogs are about gone if they aren't already, suggesting employment's going away. New export orders, any hope that the overseas economy is improving? Well, we know that's not going to happen. But look at some of what the response are saying is the economy appears to be slowing dramatically. Our executives requested we bring down inventory levels considerably. Well, it would make sense if you think deflation or disinflation is on the horizon. You might want to get rid of that high cost inventory and get it pushed out to the channels and to your people faster. How about this? Lower backlog in the fourth quarter. Well, if you have lower backlogs and you don't have new orders, well, that means you don't need workers. Customer orders have pushed into the first quarter of 2024, resulting in inflated year-end inventory. Not a good sign. And our businesses have been negatively impacted through reduced new orders for our products and services. So what we're seeing here is the manufacturing sector in the U.S. is in a dire position. Of course, then you start looking at how this flows down to retailers like Walmart. We'll get to that here in a moment, because there's been a big change and how consumers are viewing the economy. Americans are finally turning frugal after splurging over the summer. Of course, we know over the summer they still had stimulus money, so they had money to spend. And what did we know? That the labor market was indeed slowing down. We noted that minimum payments on credit cards were going up, and that was going to affect budgets. What happened in October? You might recall the student loan repayments. Well, those came back. There were a lot of things that impacted consumers, on top of the fact the Federal Reserve said the pandemic stimulus by that point should be largely gone, if not entirely gone. And all of a sudden, everyone's gotten frugal. Bad news for manufacturing, really bad news for retailers. The household disposable income side isn't looking great. Job growth is slowing, wages are slowing, which we've noted would likely happen because if you don't have inflation, you don't have wage growth. And this, according to ING, we're seeing a weaker consumer, and that's significant, and indeed a problem for Walmart. As monthly government data on personal spending published Thursday showed a cutback in discretionary categories like cars, furniture, and gym memberships to begin the fourth quarter. And what did we say was likely going to happen? Because rents had going up, but they're going to start to stabilize. We know food prices went up a bunch. They too, in the months to come, based on the data we're seeing, should stabilize. We know that OPEC Plus trying to drive energy prices higher. When you do all of that and you tack on some new debt payments, it leaves just less discretionary spending, and that backflows immediately to the retailers, to the wholesalers, and then into the manufacturers, and then to the unemployment line. Holiday shopping was also less festive, with Black Friday spending down at a number of the country's largest chains, and record amount of online purchases made using buy now, pay later, which will have a big impact on the economy coming next year when people can't afford that. Though that happened, as they noted, as schemes on Cyber Monday. And third quarter earnings from the country's largest retailer suggest a pullback is well underway. Here we have Walmart said there was a sharper fall off in sales during the last 2 weeks of October. Target comparable sales declined for the second straight quarter, and Dollar Tree, which usually should benefit from times of economic stress, flagged the increasing financial stress among lower income households, meaning that they don't have money. Of course, we noted that that is true as well. But what is Walmart up to? What game-changing thing did they just do that other retailers are soon going to follow? Well, check it out. As Walmart stopped ads on X, that's former Twitter, in case you didn't know, joining the advertising exodus. And, during boom times, and this is important to understand, companies will just spend money because they have money to spend. They don't need to worry about, and sure, they look at the data and where sales are coming from, but there's just money flowing, so they don't worry too much and they'll spend it. But when times get tight, they start to look closer at the data. They start to cut their spending. And other companies who are advertising on platforms like X will look at what Walmart's doing. They won't even need to look at their data. They say, you know what, if Walmart's not getting sales, not spending money there, well, we won't either. And we simply decreased the spend over time to align with our performance, this according to Walmart, saying they could advertise on X in the future. And this has nothing to do with Elon Musk's recent statements on or off the platform. And Walmart has not advertised on X since October, so this is not a recent pause. The company's just been organically connecting with this community of more than 1 million people on X. And of course, what you're going to see is other companies, other retailers, other wholesalers. People are going to start looking at every penny. As money dries up, you start to see changes in advertising. And what this means is other advertisers are going to look at what Walmart's doing and say, you know what? I'm not in on that either. I'm out. You need less sales staff. You need less people handling advertising. You see budgets shrinking all across the board. And what that means is other companies that support some of these big retailers, well, they're not going to need as many employees either. As far as the Fed's concerned, that's great news. As Powell brushes off rate cut bets as the Fed moves carefully, we're in restrictive territory, he says, and we don't need to be in a rush now, having moved quickly and forcefully. We're getting what we wanted to get, and now we have the ability to move carefully. Of course, he has no idea what he's going to get, and that is a massive recession on top of a financial crisis. And he'll say it wasn't his problem. Don't worry. As monetary policy is thought to affect economic conditions with a lag, and the full effects of our tightening have likely not been felt. And if that's true, and it is true indeed, well, then we're in for something far much worse. It's not going to be just Walmart cutting advertising. It's going to be cuts across the board, and mainly to the labor market. And as we know, when the labor market goes, everything else goes with it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.